All right. Well, I will take over on my side. So, Omar, thank you for that warm welcome. I'm happy to be here. I've known Omar and Jeff for years now. Is Jeff on the call, by the way? Is Jeff
Yeah, I'm
on?
here. I'm here,
Oh,
Andy. Yep.
awesome. Hello. How are you? So
Good, good.
I've known Omar and Jeff for over 10 years. We got in a couple deals together near the beginning, and then they kind of branched off doing property management and getting involved in multifamily stuff. And I kind of branched off into getting condo rentals, and then that turned into non-performing notes. But I've maintained contact with both of them over the years. It's great to see how well they've been doing. And then when I meet up with them, I tell them stories about what I'm doing. And inevitably, I would always get in these conversations with both Omar and Jeff and tell them about um, what's going on with these notes, how I'm buying them, all this basically behind the scenes stuff that most real estate investors that do fix and flips or buy and holds that they never get to see or hear about. And Omar was always fascinated by the stories that I had.
And Andy, can I just for all the new people that have just signed in, because I mean, there's still people still coming in. We got tons of people in here, man. I can barely see my screen. If you guys have a question, please type it into the chat room. We got our assistant Ratch, who's going to be monitoring the chat room, and she's going to compile the questions. Now, Andy, he's okay with getting any questions while he's talking here. Okay, so if you type in a question, I'll let Andy know, and then he'll address it there on the spot. Please continue.
All right, so I was talking about getting together with Omar and Jeff over the years and telling them stories about the notes and what goes on with them. And Omar always remarked that it was kind of like getting a peek behind the curtain and really seeing who Oz was. And so that's kind of what this talk is about. It's about giving people a little bit of a look behind the scenes that they don't normally get when they go to real estate club meetings. So I hope I do a good job of that so that you can get a different idea and a different feel of some of the other stuff out there. And then Omar has already talked to you about questions, and he'll go ahead and interrupt me if it makes sense. Otherwise, I'll stop at different points along the way. I think I look a lot better without my glasses, but I really need them so I can see. So let's get started here. So for my presentation, I'll do a quick introduction about who I am and what I've been doing and what I'm going to. I'll spend a brief amount of time talking about what non-performing notes are and how you make money with them. With a lot of real estate clubs, it's hard to gauge, everybody's experience level. You'll have people with no experience whatsoever, people who have some experience with something, and then you'll have experts. So I just want to kind of hit some key things first before going into the next part. And the next part will be the main title of this presentation, the 3 things you need when buying from hedge funds. A lot of it's going to be a lot of common sense, but I'll explain the main concepts and then go into a lot more detail about them as we go. I'll talk also about other ways to buy notes. So I'm going to talk about how I buy notes and how my business partner, Sean, how he first got into the business and how the business is for us. I didn't realize until a couple of years into having my partnership how lucky and fortunate I was. So not everybody can buy notes like this. And I want to talk about other ways to buy notes for people who are really hands-on and want some guidance on different ways to buy them. Then I'll tell some stories about notes along the way. I don't try to make this as entertaining as I can, and one of the best ways to make make any subject more entertaining is to tell stories. And so I'll talk about actual notes that we've bought, actual experiences that we have, and that will really help illustrate a lot of the points that I'm going to be making. And then finally, some Q&A at the very end. As we said before, we'll take questions along the way, but I'll also, when this is all done, we'll go ahead and address whatever questions you have left. So that's me, Andy Mirza. I'm with Coastline Capital Fund Management. I met my partner, Sean Irwin, in 2015. And since then, we've purchased $7.8 million worth of notes. To date, we've liquidated $3.9 million, resulting in $600,000 in net proceeds. The remaining $3.9 million in notes we are currently liquidating right now. We have 2 active funds, and then we're currently raising capital for our for the next fund right now. The average weighted return on investment per note was 23.6%, and the average weighted annualized ROI per loan was 30.2%. Now, just a quick word on those numbers. Really, the most accurate number to use to evaluate notes, in my opinion, is IRR, but that takes more time, is more complicated, and for my needs in evaluating notes and how well they do, I use annualized return on investment. And for a portfolio, I like to use the weighted annualized ROI, because that takes into account how much, like say a $50,000 note versus a $500,000 note. It takes that into account. What we do. So CCFM, we create and manage funds that invest in defaulted mortgages. Those are first position, non-performing notes backed by residential real estate. Most of you that are sophisticated and have heard about notes understand what this is. Like I said, there are some people that don't know anything about this, so I want to kind of start at the very basic level, just go over it really quick. What I'm talking about specifically, these are toxic home loans left over from the financial crisis of 2008. There are some that weren't originated in the early 2000s. There are some from the mid 2010s, but for the most part, what I'm talking about are those leftover toxic home loans. So our basic business model is to buy low and liquidate high. We prefer severely delinquent loans because they have the highest returns. So think of us as fix and flip guys for notes. We buy notes that have something wrong with them, that have different problems. We add value by fixing those problems, making them more valuable, and then our exit is through foreclosure, short sale. There are a lot of different liquidation paths we can take, but we can also resell the loans. Once we've added value to them, we can sell them for higher. So fix and flip guys for notes. That's how I like to describe this.
Hey, Andy, can I ask you something there?
Sure.
Do any of these notes ever become performing after you guys buy them?
Yeah. So we target the ones that are severely delinquent. So we might get like maybe 1 out of 10 or 1 out of 20 that goes reperforming. And yeah, I mean, a good example is we'll get people that will file bankruptcy on the day of the sale, and that will stay the sale or stop the trustee sale or the sheriff's sale from happening. And then if they file a Chapter 13 bankruptcy, that's a reorganization of debt, and it basically allows them to come up with a plan to take all the arrears, everything that they owe on the loan, and they'll get 5 years to pay that arrearage off while they're making their original principal and interest payment. So we have a handful of loans that we bought that were not non-performing, very delinquent, and then the borrowers made it happen and started paying on them again. So we do have some of those. Does that answer it?
Absolutely. Very interesting. Thank you.
Okay. So I want to show you guys a quick video that I had made that does a pretty good job of just explaining some of the basics, and then I'll go into more of the detail when it's done.
Non-performing note is a loan secured by real estate that is currently in default because of the borrower's failure to make payments as agreed. It's been more than 10 years since the housing crisis of 2008, but there are still lots of delinquent loans out there on the secondary loan market. Banks and hedge funds buy and sell performing and non-performing notes just like any other asset. They typically purchase very large pools and get the best prices for them. They, in turn, break up these pools into smaller groups or pools, mark them up and sell them to other banks and smaller hedge funds. The NPNs continue to be sold down the line until final disposition. Investors make money by buying low and liquidating at a higher price. By 1, foreclosing on the note and selling to a bidder at an auction on the courthouse steps. 2, foreclosing and taking possession of the property as an REO, renovating and selling the property to a retail buyer. 3, having the borrower deed the property back to the note holder, renovating and selling the property to a retail buyer. 4, allowing the borrower to conduct a short sale of the property or a short payoff refinance. 5, getting the note to reperform by having the borrower get caught up on what they owe or offering a loan modification that benefits both parties. You can take advantage of this opportunity by investing in one of our investment funds, which buys, sells, and liquidates non-performing notes.
All right, that gets a little salesy there at the end, but I mean, I think you can get the point and the value of just getting a really basic overview of what my business is about. So I want to point out some things about notes and loans that maybe some people don't understand, but they're kind of key to understanding the business. Again, some people who are not familiar with non-performing notes might not know this stuff and find it valuable to understand the rest of what I'm going to talk about. So loans are personal property and not real estate. That's really an important mindset shift that investors who come from real estate need to make when going to notes. It's really a different game, a different animal. Loans are finance. They're not real estate. They are tied to real estate, but they're not the same. Loans are loan agreements or the mortgage contracts. So it's really in what do you call it? It's not tangible, right? It's just a piece of paper, but it's the contract between the borrower and the lender. The borrower agrees to borrow a huge lump sum, and then the lender agrees to accept installment payments that are a lot smaller over time. Now, this contract, this loan, can be sold, bought and sold like anything else. So when you get a home loan, everybody who's gotten a home loan will have that experience of signing about 200 pages worth of documents and having to, prove everything, get their credit run, show all these statements, tax returns, all that stuff. So that's a business for people called originators. The people that originate loans, you have some banks, you have, Ditech, you have Quicken, you have some businesses, organizations, people that originate loans. They basically put a lot of work into making a loan, and then they're compensated by that effort by selling it. Basically, the way it works with the numbers, say someone wants to get a loan for $100,000. You'll have a bank, an originator, create that loan, go through that whole process, put people through stress, and then finally close it. And they're selling it on the market for, say, $106,000. they get to collect that delta, that 6,000, and that loan will move its way through. There are different ways it'll move up the chain, but a lot of times a bunch of loans will be put together into a mortgage bond. That mortgage bond will be bought by different pension funds or different Wall Street hedge funds and so on and so forth. It might be backed by Fannie Mae and Freddie Mac, which it's a complicated thing. But generally, I think 90% of loans are sold off. They're not held in a bank's portfolio like it used to be in the old days. So, but the thing that comes with that is that we are able to get these really low interest rates because capital gets to be pooled and buy a whole bunch of them at once.
And
So, yeah, go ahead.
I got a question here. The question is, how do you decide what to do with the non-performing note?
Okay, can we hold that question until a little bit later? I mean, because that's a complicated thing.
Okay.
Yeah. So, yeah, just hold that and remind me of that a little bit further at the end, because I really want to talk about the cycle of a loan and kind of how it goes through. So, banks and hedge funds and investors buy and sell loans like real estate investors buy and sell properties. That ties in with the first thing I put up there, that they're personal property and not real estate, but it's an important concept to get. And then when banks get in trouble, like they did in 2007, they sell some or all of their non-performing notes to other banks or hedge funds. And then like you saw in that video, then when you have these big, large pools of notes, the ones that make the headlines, they sell them to other hedge funds. Those guys keep the ones they want, and then they sell the rest off. And then it keeps going on down the line until you finally end up with the investor that's going to have some sort of liquidation to it or is going to hold on to it. So yeah, I'll go ahead and answer that question now, Omar. So our strategy on what we do with a non-performing note, we're buying at a discount, and we know that there are certain liquidation strategies that we can take, and that delta is going to be our profit. So it starts off by seeing what the borrower is going to do. So when we get something that's like a year delinquent or 2 years or 5 years, it's usually in some process or some part of the liquidation process from our seller. So a lot of times we'll buy notes where it's like the extreme example is that we'll buy one when there's a sale date pending. We actually closed our purchase of one particular loan on the day it went to foreclosure sale, right? And then that borrower filed bankruptcy, and we still have that loan because they've been paying on their bankruptcy plan. And then you have some loans where it's midway through foreclosure, and then we'll just continue the foreclosure process. You'll have others where they haven't started the foreclosure process at all. So on those loans where the foreclosure loan or foreclosure hasn't started, on those we'll always reach out to the borrower on all of these loans. Our servicer will. And if the borrower responds in kind by reaching back out to us, then we'll engage with them to see if they are interested in doing a deed in lieu of foreclosure or a short sale, or if there's a possibility of loan modification. But the reality is, for the loans that we buy, the vast majority of the borrowers are trying to, I can't actually tell what they're thinking in their heads, but I can tell by their actions that they're really trying to stay in their properties for as long as they can by paying the minimum amount that they have to. And that amount that they pay doesn't necessarily have to be to us. It could be to a bankruptcy attorney who they're paying less money to the attorney to fight the foreclosure or go to bankruptcy than they would on paying their actual mortgage. So I think that goes a long way towards answering that question, Omar. What do you think?
Yeah, that's good, Andy. Thank you. If anybody has a follow-up on that, just type it in the chat box.
Yeah, and actually at this point, this is a good time to take other questions if there are people who have questions just on the basic stuff that I just went over.
Question for you, Andy. As far as the states that your firm is buying notes in, I mean, is there a preference for states that have deeds of trust versus mortgages?
Okay, yeah, so that's a great question. So when I started out with my partner Sean, we just wanted to stick with non-judicial foreclosures. Non-judicial foreclosures mean that you don't have to go to court. It means that there's a legal structure already set up that defines how foreclosures are supposed to proceed. We're in California. California is a trust deed state. It's a non-judicial foreclosure state. So in theory, foreclosures go a lot quicker and are a lot easier in non-judicial states. Well, once I started working with Sean for a little while, I could see that there are a lot of mortgages and notes in other states, like Illinois specifically, New York, New Jersey, Florida, which are judicial foreclosure states. In those states, it's a lot different. And if you paid attention to not performing notes in the news over time, you'll know that the timelines to foreclose are a lot longer and a lot more problematic in judicial foreclosure states. The thing is, though, if you want to have access to more product, so if I look at the tapes that our sellers will send over to us of loans that they have for sale, there's a huge amount in the judicial foreclosure states. There's not so much in the non-judicial foreclosure states. So and there's a reason for that, because most of those loans in the non-judicial foreclosure states, they've already gone through the system. Whereas the judicial foreclosure states, it's a lot easier to gum up a foreclosure and have it drag on for a lot longer. Add to that the complexity of understanding and knowing how to do judicial foreclosure, and a lot of note investors will just stay away from it. They'll just say, I'm not going to buy in any of those because of the problems that you have. So a few years ago, I convinced Sean, I said, let's try some judicial foreclosure states and see how it works. And so we got involved in Illinois. We also got involved in New Jersey. And I mean, I could go on and on and on about that. But basically what it comes down to, I like judicial foreclosure states because if you can act quickly, your foreclosure timelines, even though they're longer than non-judicial foreclosure states, you're not going to have the same Fannie and Freddie timelines as the big banks and the big hedge funds. They just don't operate very quickly. So I'm not afraid of those, but so we do both, but we prefer non-judicial.
That's interesting, Andy. So it's almost like you're, I guess, fishing in a bigger pond with less competition, so to say, and because the level of knowledge is so much higher, it gives you an advantage there.
Yeah, that's correct. It opens it up for more ponds to fish in, and then if you have the expertise and the knowledge, your speed of execution can drastically speed those things up, because when they know that they have a longer timeline, they sell them at more of a discount because they know it will take longer to get there. But if I can get past that longer timeline, then I'm good.
All right, now we got the series of questions here. First question here from Peter is he's asking if we can get a link to this presentation. Even though we've just started, she's already impressed with it. So,
Well, I think you can answer that question, but I definitely want to have the information of the link as well.
okay, great. So we'll make that available somehow.
And maybe
And-
one more question, and then let's keep moving.
Okay, sounds good. Matt asks, do you buy first position only, or do you also buy seconds? And if so, what ratio?
I only buy first position mortgages. My very first note purchases were actually joint venture purchases of second mortgages or second liens. But with my current partner, Sean, we only buy firsts. He considers seconds to be a lot riskier. And there's a huge difference between second position loans and first position loans and different strategies. It's a whole different animal. And so that's we stick to what we're best at. And yeah, that's the answer to that.
Okay, great. Thank.
So yeah, let's move on. Or did you have something?
No, that was it.
Okay,
We'll
yeah.
go back to the other questions later.
Yeah, sure. I'll do this next part and then answer some more questions, and then yeah, definitely hold some of the other ones till the end. Oh, I I forgot to add this point to it before we go to the next slide. So also remember that what the borrower owes on a lender is fixed by the note agreement and can be completely different than what the current note holder bought the note for. So for that $100,000 loan, as an example, it gets originated. The originator sells it off to a pension fund for $106,000. Pension fund doesn't have to go through all the work of creating the loan because it just wants cash flow. Well, when things go wrong and it stops performing, well, they might decide to sell it for 80% of the face value. So, but the contract doesn't change for what the borrower owes the lender. The new purchaser, which would be me or anybody else, even though you bought the loan for $80,000, that borrower still owes you the $100,000 plus whatever extra interest or fees that they would owe. So that's an important concept to know, that what you as the note holder buy it for is completely separate from what the borrower owes on the loan.
Great.
So the first component, and this is going into the first thing of the three things. I'm getting a little bit of feedback, Omar. I don't know what that's from. I hope it's not me. But the first component is access to the right people. And by this, I mean so when I was talking about these different hedge funds selling the different pools of notes, I'm talking about the better access you have to get up the chain. Like the higher you can get, the better discounts that you can get, the better quality deals you can get. By the time hedge funds keep the ones they want and sell off the rest, and then do that 2 or 3 times, kind of what's left at the very bottom is the stuff that nobody else wanted. Now, you can go panning for gold. You can, sift through a whole bunch of kind of the bottom stuff, and you can find those gold nuggets. But the much better way to do it is to get farther up the chain to where they're really mining the gold, and then you have better chance to get better deals. Also, the better your network, the better your prices you can get when reselling the notes. So it kind of works better both ways as far as having the access to the right people. One of the things I found, and this is no offense to any note investors out there, but a lot of us, we love to pay like the least amount that for any of these notes that we can. Kind of the going rate for the secondary market for performing notes is we want to see 9 to 12% yield. And so that affects the price that we're willing to pay. But if you have connections to banks, that like reperforming notes and their cost to capital is low, they don't mind getting something that has a 6 or 7% yield. So you can sell to them for a lot higher price. Ease of doing business. When you have access to the right people, and I'll talk more about this later, the higher quality connections you have, the easier it is to do business. The worse your connections are and the less trust you have, then you have more problems. We have the ability to cherry pick loans, and that has all to do with the access that we have with our sellers. For a lot of note buyers out there, they don't have this opportunity. They see a pool of notes, and it's an all or nothing kind of deal. With us, it's different, and that has to do with the quality of the access you have. We also get great post-sale support. Again, this is something that I didn't realize was such a big thing until after I had been working with Sean for a couple of years. My experience working with Sean was that if we had a problem with the loan, even after we bought the loan, our sellers would do everything in their power, bend over backwards to get us the documents that we need. I didn't realize until I spent time on Bigger Pockets or at networking events, and I heard stories from other note investors, and they would talk about how once they bought the note, that was it. And if they didn't have the documents they need, they had to work the hard way. The better access you get, the easier that kind of stuff is. An example I have with that, we bought a loan in Grand Prairie, Texas. Well, the property's in Grand Prairie, Texas, several years ago, with the intent of going through foreclosure and liquidating the loan. This gentleman ended up filing bankruptcy actually twice. The first time, things didn't go that well. We tried to foreclose again. The second time he did it, he got everything lined up and started paying us on a regular basis. So after about 2 years, we looked at selling that loan. So we're talking like almost 3 years after we bought the loan. When we tried to resell it, we discovered at that time that there were a couple of issues with title, because there were a couple minor errors on the assignment documents, and it went through like a few different lenders. So let me just explain a little bit more quickly for people who don't understand. When you sign that loan document, that's the note. What also gets executed at the same time is you get a deed of trust, or you have a mortgage if you're in a judicial foreclosure state. That mortgage, the deed of trust, is your security instrument. That is what allows you and gives you the power to foreclose on the property. The property becomes a collateral. Now, whenever you sell a note, or whenever you buy a note, the thing that you'll get the original note document. You'll get something called an allonge or an endorsement, but you'll also get an assignment of mortgage or assignment of deed of trust, and that document gets recorded. That document says this seller sold the loan to this buyer and assigns everything to that person, right? So going back to my story, so a few different lenders had these errors on the assignments. Well, if I want to sell this note to my buyer, he wants to have all those things fixed. Otherwise, there are defects in the title, and then if you have a defect in the title, then they're going to ask for a discount. And some buyers are very picky, and they won't even buy it if it has a certain amount of defects. So we had a problem. We couldn't sell this loan for what we wanted to without fixing these problems. So we went back to our seller who sold us the loan 3-4 years ago, and we asked them to help with the documents. This is like the equivalent of like you sold your property, and 3 or 4 years down the line, the buyer is coming back to you because they need you to fix something with the house. It's just, that's not going to happen. Once you close escrow, that's it. You're done. But if you have great access, you have a seller who's going to try and fix the problems with you. And that's what they did for us on that. So who are these people that have access to the right access and the high up that chain that I'm talking about? So these are traders at Wall Street funds in charge of the whole loan trading desk. They're not all on Wall Street. Wall Street hedge funds is just an easy catch-all. Some of them are in Connecticut. Some of them are in Texas. Some of them are in Tennessee. But basically, those are the guys. Typical profile. Now, this is more true of when my partner Sean got in the business. And I'll tell you his story in a minute. But typically, these are guys in their early 20s and 30s. They're typically just graduated from an Ivy League school, and they go to work for these big firms. And that's kind of like a bottom level job, is asset manager. Today, a lot of these exact same guys are doing it, but now they're older and have kids. And yeah, it's more. I'll explain more when I talk about Sean's story. But basically, even today, no matter what fund or big private equity firm you're talking about, usually there's a guy or a woman. I haven't met one yet though, but there's someone that's in charge of selling assets for that fund or that company, and that's the person who you need to get in contact with.
Hey, Andy.
Yeah, go ahead.
Can I give you a few questions here? Is this a good time for a question?
Sure, go ahead.
Okay, so Matt is asking, how has the CARES Act impacted how you can foreclose on a borrower?
So I think the CARES Act we're talking about recently with COVID-19 and that kind of stuff. Is that correct? Is that what you're understanding?
Yes, I believe the CARES Act. Well, I know it's there's restrictions on evictions, and I know foreclosures. I think there are some restrictions on foreclosures as well.
I just want to make sure. So the CARES Act. So far on what I currently have, it has no effect. It has no effect, right? Okay. And the main reason why, and so when I was telling you about these loans that get originated, and a lot of them stay in these mortgage bonds that are backed by Fannie and Freddie, those are supported by GSEs, government-sponsored entities. If you have FHA loans, if you have VA loans, I think there's USDA loans too that are all federally backed. Those loans have certain rules with them, and those are the loans that got affected by the foreclosure moratoriums. They're the ones that got affected by the automatic forbearances for 6 months or 12 months. So those loans, they're not what I'm talking about. And in the future, it's going to be interesting to see how that will affect how I do my business in the future. But there's a lot of stuff out there that once it went non-performing and sold, it's pretty much, it's not backed by HUD or Fannie or anybody at that point. It's to, at that point, the lender does not have those restrictions. The only restrictions are from states and local governments that have laws that govern foreclosures. And so I'm affected by those. So the different states during this whole coronavirus lockdown, they've all responded differently in how they treated foreclosures and evictions. So I was affected by that, but not by the CARES Act specifically.
Okay, and then another Matt here asks, how does an individual investor take advantage of this method?
Well, that's what I'm talking about. So I've started out by identifying who the people are, And now I'm going to start with where do you meet them? And then I'll continue to explain more and more and more.
Sounds good.
Okay. So where do you meet these guys, these loan traders that I just talked about? So their offices, and I'm gonna just pause for a brief second. I mean, if I were in front of an audience, I would be. I like to get kind of some interaction and ask some questions and get feedback. So just humor me. So I would ask you, who here has heard of Tony Alvarez? And I would hope that a lot of hands would go up. And then I would ask, do any of you guys remember how Tony Alvarez talks about developing relationships with REO agents? And then I would hope that a few more hands would come up. So what I'm about to talk to is very, very similar to what Tony Alvarez talked about how to develop relationships with REO agents. It's really very similar. There's one big difference, and I'll get to that point. But Tony would see this and say, "Of course, that's how you meet them. You go shake their hand. You go to their office. You go where they are, and then you take the initiative and establish that relationship." Trade conferences. That's another big place to meet them. If you don't want to go out to New York, there are different trade conferences that you can go and network with these guys. So IMN is a big one. They not only do secondary market conferences, they do conferences on multifamily, they do conferences on servicing, they do a lot of real estate related conferences. You don't even necessarily have to pay to go to the conference. We actually don't. I think I know my partner, he used to pay to go into those conferences, and then he started just going to the hotel bars where they had the conferences at. So he would just hang out at the bars because at the end of every conference, everybody would go to the bars and hang out. And that's where he would develop his relationships. And that's an easy tidbit for people. So you can also look up secondary mortgage market, see what comes up, asset-backed securities. There are certain conferences to go to. And I just briefly touch on these, and it's just to give you a little idea, and then you can do the research on your own. There are conferences that are better about learning, especially about different niches. But specifically, when I'm talking about getting access to these people, these are the conferences that they go to. They don't go to some of the other note conferences out there. Yeah. You can also find them online. This might be a little bit harder to do, but I think when you're trying to meet somebody for the first time, definitely their offices in person or on the phone is definitely the best. But if you want to identify them, finding them online through Bigger Pockets or LinkedIn are good ways to do it. So that's my partner, Sean Irwin. He's the other half of Coastline Capital Fund Management. And I want to tell you the story about how he got access. So he was a mortgage originator in the 2000s. When he saw things starting to go bad in like 2006, 2007, he started looking and just getting a feel that, you know, there was this financial collapse in mortgages coming. So he started looking at REOs and how he could get REOs and get into those deals because the mortgage business was drying up. He ran into somebody who was saying, hey, why are you looking at the REOs? The better deals are going to be these non-performing notes. So, you know, go try and get those. So he didn't know what a non-performing note was. So he learned about it, and then he set his mind to getting into that business. Now, he was getting hit hard with the financial crisis, like a lot of other people were, I think. And so he kind of went all in with getting into the note business. So he told me stories about how for a whole year he was spending about 20 hours a day, Monday through Friday, just on the phone all day, every day, Monday through Friday, calling people, calling brokers, calling the guys in charge of these whole loan trading desks. He would take trips out to New York City. He would knock on doors. He would have these meetings with these guys and with these people with the product. And it was hard for him to break in. So after about a year, he finally got his foot in the door and did his first deal. He got his foot in the door on one trip to New York. His first meeting was with the guy in charge of all the non-performing loans at JP Morgan Chase. And he tells a story about going to the skyscraper in Manhattan, and about how when you're in the lobby, they just don't let anybody walk in the door and walk right on up to see who they want. They have high security down there. So he got stopped at security. They called up, and the guy he was supposed to meet with, really a big shot, was like, I don't have time for him. Tell him to go away. And well, Sean is he's a unique individual. He is very outgoing, very extroverted, and very persistent when he gets his mind to it. So that's where he drew a line in the sand. He said, hey, we had an appointment. We're supposed to meet. I'm not leaving here until I get a chance to see you. And so security didn't know what to do. They called up to this guy that he had the appointment with. The guy asked security to put Sean on the phone. He said, hey, Sean, what are you doing, dude? I mean, just leave. I don't have time. I can't see you. And Sean said, no, we had an appointment. I want to make a deal with you. I'm not leaving here. You're going to have to get security to call the cops and arrest me and get me out of here for trespassing, but I'm not leaving. And so finally the guy said, all right, if I let you up here and give you 5 minutes, will you leave after that? And Sean said, yeah, you give me 5 minutes, I'll leave. So security let him up. He talked his way into one loan. The guy gave him a chance to broker that one loan. So Sean left, scrambled to find capital, find a buyer, got that person. They closed on that loan in a month. And Sean did what he said he was going to do. And after that, when they saw that he could close the deal, they said, okay, I got 5 more loans for you. Can you sell those? Sean came back and sold those loans in a month. And then that opened the door and the floodgates. And over the next few years, that led to more and more deals. And then until he and his partner bought $250 million worth of notes over 3 years. Like I said before, I'm really lucky to have walked into a partnership, with this kind of access. At first, I just assumed that everything that I encountered when I did business with Sean and with his partners, I assumed that was normal for everybody. But then after a couple of years, I saw that it really wasn't. All right, Omar, do you have another question or two? Because we're going to the second component, so this might be a good time for another.
Yeah. Okay, so the question here from, this is Matt again. How do you determine the price you're willing to pay for a note given it is non-performing?
Ooh. So I'll give you some general answer to that, but at the end of the day, it's kind of a secret sauce between me and my partner, exactly, how we determine it. So I'll tell you some basics. So if the property is underwater, that is backing the loan. So you have that $100,000 loan. If the property is worth $50,000 and you owe $100,000 on it, that's called underwater. So no normal person for a non-performing note where basically you're looking at the physical collateral to back it up is gonna pay more than $50,000 for sure, right? You're not gonna pay $100,000 for a loan if the backup is worth far less than that. In that situation, you bid on a percentage of the market value of the property. So in that situation, with a property worth $50,000, and I'm just using this as an off-the-cuff example. There's a lot more that goes into it. You would have to look at that market, like that state, the type of actual property, to determine to find out what the market rate is. So say for that particular property, the going rate for buying these kind of non-performing notes is about 75% of value. In that situation, whatever the math is, 75% of 50,000, that's what you offer on that, right? So the loan, you owe 100,000 on it. You're not going to pay more than like what is that, 35,000 for it. Now, say that property is actually worth 200,000, but it's the same loan of 100,000. Well, you're only entitled to collect what's owed on the loan. You're not entitled to the equity over that, anything over that. So if that $100,000 loan, and let's just make the example simple, accrued interest, your foreclosure fees add up to another 20,000. So the total debt that you can actually collect is 120,000, not the 100,000. But if you take that to an auction, and I'll make it even more clear. If the property is worth 300,000, there's so much equity above what's owed that you're guaranteed to collect the entire collectible debt of 120,000, right? Because there's so much equity. If that goes to foreclosure auction, somebody's going to buy that property. So in that instance, you're going to buy a percentage of the total collectible debt, which, depending on the state, can be somewhere between 75 and 90% of that amount, right? So if you know for sure you can collect 120 grand, you might be willing to pay 90, 95, or even more than that. So that's kind of the basic two scenarios, but I could fill up a lot of time and go into a lot more detail, and then there's some secret sauce, but I think that's a good answer to that question.
Okay, yeah, that's great. The next question here comes from James. He's asking, what is your average time frame from acquisition to liquidation of a note/position?
Okay, so from acquisition, so the acquisition timeline is usually about 1 to 3 months for us, for each of our funds. For an individual note might take maybe 2 to 4 weeks to buy from the beginning of the buying process to the end of the buying process. Now, the liquidation portion of it, the average liquidation time for us is 6 to 18 months. So it's kind of a range in there, but it really depends on the note, because we buy some notes where it's almost done. We buy some notes where it's almost done and the borrower files bankruptcy or fights a foreclosure, and then you go off longer. And then we have others where it's right at the beginning. So the average time, 6 to 18 months. So I'm looking at the time and I'm thinking I really should go through more of the slides first. And
okay. We'll come back to a few more questions as we go along.
Yeah, if you can reserve the questions more to the actual topic I'm actually talking about, so that way it's relevant to the actual slides I'm on, I think that'll be better. And then the questions that are not related to the slide, let's just keep those for the end. All right, so second component is professionalism. So the first one is access to the right people. Now we're talking about, well, once you get to know those people, how are you going to act? So you got to keep in mind, buying notes is a lot different than buying real estate. In some ways, it's kind of backwards. When you're buying your notes, okay, and then sellers will expect you to behave a certain way. And when you're buying notes, you generally agree on price first. Then you do a due diligence phase. Then at the end of the due diligence phase, then you go to contracts and you sign contracts, and then you fund it the next day. It's a lot different. To get a note in contract is generally you're bidding with the seller, going back and forth by email, and you both agree on the price. That's going into contract. That seller, if he's, if it's a good relationship, he's going to stick to it the whole time. And then you fund your deal at the end. With real estate, you pretty much, you lock up the deal first, and then you go for getting your capital later. So professionalism, the first part of that is understanding how to do the business right. And then I'll go into each of these sections into a little bit more detail. If I don't and I miss it, feel free to ask questions later. But there's a certain way you act when you're bidding on product. There's a certain way you act during due diligence. If anything comes up during the due diligence phase, like if there's a huge difference in pricing between if there's a huge difference in market value of the property, like say the seller says, oh, this property is worth 200,000, and your BPO comes back and it's worth 150. Well, that gives you room to negotiate a reprice, because your bid is based on the information that they give you. If there is something wrong with title that comes up, the first thing you do is you let the seller know, hey, there's something wrong with title. You give them a chance to fix it, because it might be just a certain document's missing and you just need the document. So that's an easy fix. But if it's something that can't be fixed, but affects the value of the loan, then you go into this repricing phase where you're actually rebidding back and forth. And you either agree on a reprice or they just pull it from the trade and you take it out. Like I said before, then once you finish up with your due diligence and do any final repricing, you sign contracts, and then you go and fund the deal. That's kind of how it works, and how the traders expect you to act.
Andy, let me just touch on something there. In the due diligence,
Sure.
Is there like a first thing that you look into, that you focus on from the get-go? And is there a common issue in due diligence that is more common when you're looking at these notes?
Okay, well, I'll answer the first part. I'm not sure about the second. So we have a process for our due diligence. So getting to due diligence, we've already agreed on price. We're doing our due diligence. We order what's called an O&E report, which is ownership and encumbrances report. We get ours from Pro Title, or actually there's another vendor that we prefer because we like the reports better. It's basically a report from a title company where they pull all the recorded documents to show. It's kind of like a mini preliminary title report, kind of like that, except it just shows you recorded documents for it, so that you can get a picture of the loan and the property. We also, that costs about $90 or $100. We also order a BPO, which is a broker price opinion, which is like an appraisal light. It's done by real estate agents, and it costs about $100 for a 5-day BPO. We also order a third-party due diligence report through a vendor, and that costs $200 to $300. And they will go through all the files, because once you agree on the price and you go into due diligence phase, the seller gives you a Dropbox link or some other file sharing link where you have access to all the image documents related to that loan. And I mean, we will go through a lot of that stuff on our own, but we like to have a third party company sift through all that stuff as well, because they do a really good job of not only are there a second set of eyes on the loan, but they'll also kind of collate all the information and put it together in a nice Excel spreadsheet. So it's easy to keep track of, and they let you know what's wrong with it. But that's a huge part of the due diligence process. And I think your other question was about, are there common things that we see? And
Common problems.
Common problems. I don't know how to really answer that one, because we see so many different things.
Okay.
We see some things that happen kind of every now and then. They're more frequent, but I could really spend another couple of hours talking about due diligence,
You could, yeah.
and kind of not get through this. So I'll just kind of leave it at that for now. And then if we have more specific questions, we can answer it at the end.
That sounds good.
So understanding the traders. So here's going to be a huge difference between Tony Alvarez's REO agents and these guys. I'll address that at the end, but actually the rest of this stuff is going to be pretty simple. Well, actually, no, it's right there. Okay, so these guys, typically their compensation is not tied to any one particular asset. It's an important concept to have. So the REO agent is actually the opposite. Their compensation is directly tied to each REO asset they have. So that's a key difference in using Tony's style of developing those relationships with what I'm talking about with these loan traders, right? They are doing what they have to make their bosses happy, have minimal stress, and keep their jobs. Typically, they're getting paid a salary or some vendors an hourly wage, but you know what any particular non-performing note doesn't really make a difference to them. Their bosses will tell them, hey, you got to liquidate, X portfolio. And that basically means, put X portfolio out for bid and make the deal happen. And they usually, they will not be in charge of determining what the final bid price is. They'll be in charge of facilitating it and then getting it to their bosses, who they have their different criteria of what they have to do, right? And their bosses are telling them, you have to liquidate and do this kind of stuff because we need to hit our quarterly numbers. We have to pay out dividends, or that portfolio is run by X investor and they have this criteria. So you have a lot of people in the chain that have to do a job where their incentives are completely different than what your incentives are. And this explains a lot when it comes to buying REOs. If you're an REO buyer of real estate and you just can't understand why the banks are doing some of the things they do, or you see vacant homes and they've been vacant home for years and you're trying to figure it out, these guys in charge of it, they don't care. They absolutely do not care about that particular property. It could be in your neighborhood and you drive by it, every day for 2 years and nothing happens to it. The people in charge of that, they don't care. They have other higher level stuff that occupies their attention, and that's just the way it is. So going to understand the traders, these guys don't want drama or headaches. So if you're used to real estate transactions that go in and out of escrow a million times, these guys don't like that. And it's a completely different world. They don't, if they get involved in a deal to sell a pool of loans to somebody, they don't want that person to come back and say, I changed my mind about it. I don't really like it, or I can't get the money. It's that will make them not want to do business with that person ever again. So a headache for them is a trader with someone that causes unnecessary problems. Like I said, that professionalism, that way of acting. If you're not acting the right way, it's making more friction in that person's life. The ultimate headache is when someone blows a deal. So if you got to the point where you got access to the right guy, and then that guy gave you access to this product and let you bid on some loans, and then you got into the whole process of all this stuff, and then at the end of the deal, you don't fund. That trader's boss is going to be pissed, and they're going to be pissed at that trader for getting in the deal with whoever is blowing it, right? So that happens once, and they're like, no, we don't do deals with that guy anymore. What happens when you do it the right way and you close your deals the way you're supposed to is that you can keep doing the same thing. They want someone who is easy to deal with and makes them look good. So, I mean, you get involved in that deal. The trader trusts you. You make it happen. Then they look competent and they look good to their bosses. So to develop these relationships, use the phone to start off with, unless you meet them in person, like I said before. It's going to be up to you to keep the connection alive. You're the one who has to take the initiative. And I'm going to say a bit about that in a minute. Visit in person when you can. Be responsive. When you get a trader's attention and they send you loans to look at, respond quickly with a yes or no. If it's a no, give them a reason why you said no. So as I get more involved in this business, I've gotten a lot more involved in LinkedIn and putting myself out there as someone who buys non-performing notes and liquidates them. Well, I buy and sell them. I mostly buy, sell some, but mostly liquidate. Over the past, I'd say year, I've gotten hit up maybe 60 to 70 times by people on LinkedIn and also on Bigger Pockets. And a lot of people are like, oh, do you have any non-performing notes for sale? Oh, do you have performing notes? Do you have this? Do you have that? And, you know, I only have non-performing firsts, or I have reperforming firsts. And I've taken the time to say to a bunch of people, oh yeah, I've got some reperformers in these states, and you know, I can send you the tape. I can let you take a look at it. Out of those 60 to 70 people, and maybe I actually sent stuff when they responded, oh yeah, show it to me. I probably had maybe 30 to 40 that I actually took the time to send them stuff. And at the beginning, I just send them a tape, which is an Excel spreadsheet. It shows the different loans. And out of that many people, I might have had maybe 5 or 6 that went like 2 or 3 or 4 steps beyond that, but never bid, never did anything else. I had no follow-up from people. And I realized that I'm on the other end now, right? So now I get to feel what it's like, where I have people that are asking for my time and attention to show them stuff, and they don't have they're not responding the way I think that they respond. They're not responding the way my main sellers. We have a definite way of keeping in contact about stuff.
Andy, sorry, I came late, so I missed a good part of this, but I just wanted to say, why do you think it is that people are not responsive? What is your take on this?
My feeling is, I think a lot of people, they find out about non-performing notes. They think it's a great idea. And then they start trying to do what they think they need to do. And then it gets too hard. And then they kind of drop down to a level where it's a lot easier. That's the main reason why. Because if you want to get the best access, you have to find the right people to have access to, and then you have to be persistent. I told a story earlier about my partner Sean. Incredible persistence, incredible drive to get to where he got. And just when I heard his story, I don't know if I have that in me to do that same level and keep that level of commitment up. So I think that's the main reason why people don't do it.
Okay. All right. Thank you.
Hey, Andy.
Yeah.
Just touching on that last bullet point, give a reason why you said no. There was a question that came in. This is from another Mike here. How do you vet the note? And he's got in parentheses, not to buy a firehouse. I guess if how do you know? And I guess you kind of answered in the beginning. You guys hire outside due diligence.
Yeah. So you have to assume if you're dealing with a reputable seller, you have to assume that the loans that they give on that tape are legit loans. I mean, the people that we buy loans from, they're not going to fake us out. I mean, this is legitimate stuff. So we base our bids off of what we can see. And then, the due diligence process, we look at the note, right? All the image files, we look at the note. We look at the mortgages. That O&E report I told you about, that's a third party verifying through public records that all the stuff I have in front of me, the recorded documents were actually recorded, right? They're not fake recorded documents. And then that due diligence company, they do some of their own checks too. So there are a lot of ways to actually vet the note.
So it sounds to me because of the level of professionalism. You say you're dealing with guys that are coming out of Ivy League schools. They're working for the top banks out there. There's a certain level of professionalism that these guys are not going to send you garbage. They're going to send you something that's legit, like you said. That's the expectation.
Right. I'm saying at that level, that you're like I said with Sean, he was dealing with J.P. Morgan. He was dealing with Goldman Sachs. He's dealing with Fortress, Carrington, like all the big names. I mean, they're not going to waste their time. These guys on these trading desks, they're managing thousands of loans. It's millions and sometimes billions of loans. They're not going to waste your time on garbage. And that's why I said that if you're encountering garbage, I think your access level is not as high as what I'm talking about.
All right, very helpful. Thank you.
The golden rule works great in these relationships. Do unto others as you would have them do unto you. Quick story on this. So I think it was a year. Yeah, I think it was a year ago. We were buying a number of notes for one of our funds, and we came across this high-end Chicago condo loan that I looked in really briefly. One of the things that we do is when we see an address, we'll Google the address and look at where the property is, and I could see that this was really just a really nice condo, probably worth about $800,000 in the Chicago area. We didn't have enough to buy it. We had enough to buy it, but when you're buying a pool of notes for a fund, we like to buy in the $70,000 to $250,000 range, because we can buy more assets, and that allows you to spread the risk over a lot of different ones. If you sink all your money into one asset, high priced, if that one doesn't go well, all your fortunes sink or swim on that one. Just like, if you have a fix and flip business and you do a whole bunch of them, if you do high end ones, it can kind of hurt you. So if it goes wrong. So I didn't think anything of it, because I started looking at other ones, and then we had a foreclosing attorney in Chicago, and he knew that we bought notes, and he was handling a couple foreclosures for us, and he sent us an email. He said, "Hey, what do you think? What do you think about this loan? I have someone who's trying to sell it." And I looked at it, and I was like, that's the exact same condo that I looked at that my trusted seller showed me. So I was suspicious, and so I called up my seller and I said, "Hey, just want to let you know, on this tape, you have this Chicago loan. Somebody just tried to sell me that loan." And he was like, "What? Really?" And he explained to me that he had engaged to sell that loan to someone else, and that guy was stalling. He was at the end of the due diligence part, but he wasn't funding the deal. So he was suspicious, and when I told him that I had heard from a different source about this same loan, he was like, "Yeah, that guy's probably trying to find money so he can buy that loan." And as soon as I told him that, he pulled that loan, and that guy is no longer on his list of people to sell to. If you have a trusted relationship, you don't go and try and broker the loans that they show you unless you have permission to, right? If the seller, if you say, "Hey, I don't have enough, but I have another person who might," if they're open to you brokering that deal to somebody else, then go for it. But don't go do an end run and do that kind of thing. So that's kind of like these relationships. They're serious. They're good. They're great when you have them, but don't screw them up. Not by doing something stupid like that. So the last component, this one's a really quick one. So let's motor through this one. I've got a few more slides. Well, Omar, just so you know, I've got about 6 or 7, 8 more slides left. And let's try and get through those. And then we can hit the rest of this Q&A. So ready access to your capital. I explained that this is kind of different from buying real estate. Real estate, you tie it up, and then you find your financing after. This, you have to have your cash or your line of credit available before you bid. You really do. When you're bidding and the other guy accepts your bid, he's expecting you to fund that as soon as you're done with your due diligence, right? So if you're not sure that you're going to have that money, don't commit yourself, because that'll put you in a bad spot. When due diligence is coming to an end, move your money if necessary. So, with us, we're non-leveraged. We don't use any lines of credit. So we have that big chunk of cash ready in the bank. So when it's time to close, we go to contracts, and you send that wire within 24 hours. If you're using a line of credit, just like I said, move that money to that account to be ready to fund it. If you don't do it, you risk blowing the trade. And if you blow the trade, they're not going to want to do business with you again. All right. Omar, I have this story that'll probably take a little while. I'll get your opinion on it. I wanted to go into detail on a complex.
That's not the one I had a visit for you, is it?
Yeah.
Oh, okay. All right. That'll be fun.
I think it will be fun. I know guys have questions out there, but I know it's going to take a little bit to get through this. And then after this, I wanted to do the other ways of getting notes for those who don't want to do what I just talked about. But I think this one would be kind of a fun one to go into, just to see what the world of notes can be like. So this one is one of the most complicated notes that I've dealt with. I've had others that have had kind of the same level of complication, but this is a good one. So I'll just dive right into it. So I misspelled delinquent. Oh, I'm such an idiot. 10 years delinquent is what it's supposed to say. NPN story condo home run. So really quick, just recently I was buying a car from a car salesman, and we were talking about what I do for business, and I kind of casually dropped that this borrower hadn't made a payment for 10 years. And I was actually talking about a different mortgage. And he just looked at me, his jaw dropped, and he said, how can someone go 10 years without making a mortgage payment? Well, surprisingly or not surprisingly, there's still a lot of that stuff hanging around. And the longer I hang out, the more I see it. So let's get into this one. So this loan was backed by a condo in Highland, California. The total delinquency on it before we ended up foreclosing on it was 8 years and 340 days. The reasons for the delay, so it varies from note to note, and I'm learning stuff every day and experiencing different things all the time. I really do. It's exciting if you're a note nerd like me. So reasons for the delay: 0% borrower's actions. The borrower did not contribute to the delay. Complicated title issues, 50%. Inefficient big bank and attorney firms, another 50%. So here's a picture of the condo complex and kind of what the condo looked like. So we first encountered this loan a few years ago. And at that time, I saw that the valuation was kind of low on it. And the reason that this condo is so great, and Omar piped in about it. So I bought about 25 condos in the Inland Empire in 2011 and 2013 at trustee sales. I'm still holding on with a partner of mine to 19 of those. So I was intimately familiar with this condo because of personal experience. I didn't have a condo in that exact complex, but I have a whole bunch of other condos very close by. And this is kind of interesting because we're buying in a lot of different states. So we almost never have that kind of familiarity with different properties in different markets. This was kind of a unique situation. So we saw the loan the first time on the tape. The valuation was kind of low. And then we could get access to the surfacing comments of the note, and we found out that there were title issues. What we found out was that this was a HELOC, a home equity line of credit, which is generally a second mortgage, but sometimes it's a first, that was taken out by the borrower in like 2004 at the height of the bubble and all that. The title issues were that there were a couple of unreleased loans from like 10 and 20 years ago that they needed to go through a quiet title act to clear the title. Well, at that time, we didn't feel like going through with even bidding on the loan. So we just passed and bought something else. So the next time we looked at it was about a year later. We saw that the note was still on their books, and we looked at it and we saw that in a year that they had made progress. It looked like the quiet title action had been, initiated and they'd gone to court. So we were like, I really want to bid on this thing because I think their value is so low. I think the condo is actually worth a lot more. So let's bid on it. So we bid on it. There were 2 old mortgages on it, like I said. One was a wraparound loan. So let me just make it, I'm trying to make it as simple as I can, but the more I look into it, the more complicated I see it is. So there was the original loan on the property from 1983. And then there was an owner who sold the condo in 1997 by doing a wraparound mortgage. A wraparound mortgage is when you create a new mortgage without paying the old one. So he created a new loan that had the existing mortgage still on title. And so he would collect payment from the borrower. And then in turn, he would pay the old mortgage and keep the delta for himself. So those were the old mortgages that still hung around. Now, what's unusual, and so Omar asked a little bit earlier about common problems that kind of come up in due diligence. So one of those problems is that a lot of times you'll see a big loan that was taken out in 2004, 2005, which is the note that we're trying to buy. And then you'll see sometimes on title, you have these old loans that don't look like they were properly released. Now, for us, most of the time, all we have to do is find a title, title insurance. So when these new loans get done, they get a title insurance policy that basically guarantees that they're in first position. Well, once most other cases like this, if we find that there's a title insurance was issued, then we know we're in the clear, and that it just because we could always file a title claim, and it's really the title company's problem to get rid of those old mortgages. In this case, that big bank, their practice was not to get a full title insurance policy. They would do a title search, but they never did a real title insurance policy. So they probably paid those old mortgages off, but there's really no recourse to making sure that those mortgages get paid off. Okay, I'm going to try and go a little bit quicker. I know I can get really into this stuff. So you have someone who took this loan out. Let me see. Okay, hold on. So this HELOC was done to pay those 2 old mortgages off. But what happened in the downturn, that mortgage was maybe $180,000. The value of that property went down to about $40,000. This property was also non-owner occupied. So basically what happened was that original borrower had this as an investment property, and reading in between the lines, they just let the mortgage go. Because why owe over $200,000 on a $40,000 property? It doesn't make sense. Well, with HOAs, if you stop paying your HOA dues, the HOA can foreclose on you. And on this particular property, the HOA foreclosed, I think, up to 5 times. So in this situation, the borrower was in the wind, the HOA had taken over, but you have this mortgage that's stuck. Nobody's paying on the mortgage, and you have big banks and you have big attorney firms that are trying to deal with this problem. And this is like a zombie condo, right? The HOA forecloses, somebody else takes over. So another thing about this condo is that they have a really low asset valuation. My seller, they had it worth $85,000. I knew from my personal experience, it was worth $130,000. And to make this really long story even shorter, I won't go into all the details, but their valuation was actually a good valuation. They were using comps from a condo complex about a quarter of a mile away. That's like the worst condo complex ever. Has a whole bunch of like crime problems. Unless you have local knowledge, you wouldn't know that there was day and night difference between valuation, and you shouldn't use that for a comp. but because I knew from my experience that the property was actually worth 130, I had a huge advantage on my seller. So when we bought the loan, everything transfers over to us. And what happened with this one is that a big well-known firm was doing the quiet title action. And it turns out that they weren't doing a very good job of it. They were dragging their feet. They weren't responsive to us. We could never call an attorney directly. So within a few weeks, we decided that we wanted to get rid of these guys and find somebody else, which we did. We found a small attorney shop with a sharp attorney, and he advised us to do something that none of the big banks do. So the big banks, they work in steps. You have a title problem, clear the title first before you do anything else. This guy, he said, you know what? Go through with your foreclosure. You know the borrower's not around to fight you. Nobody's going to fight you on this. And then we'll work on clearing title at the same time. So that's what we did. We proceeded with the foreclosure, foreclosed on it, and then we cleared title. And how did we clear title? Well, let's go back here. Clearing title was a matter of our attorney tracking down the two different loans. He found that one loan had actually been reconveyed within the last year. The other one, he tracked down the person who did the wraparound loan. We gave them some money and had them execute the documents because they were actually paid off when that original loan was done in 2004, 2005 that we bought. They were paid off. We paid them some extra instead of going through court. We got it cleared. So then we had to deal with the uncooperative tenant. That's kind of where Omar and Jeff came in. They have a property management company, and they've been helping us with our rentals, and they helped with this one by trying to get in contact with the occupant. This guy did everything he could to avoid us. We had to start the eviction process, and in California, you have to wait 90 days after a foreclosure. Once we started that eviction process, and we were about halfway through with it, we were contacted by the mother who actually turned out to be a real estate investor, and her son had bought the property a year prior, and he probably thought it's going to take the bank forever to foreclose on this thing. And then he was trying to stay in it for as long as he could. So she arranged cash for keys. We got him out. And then we got a bonus. So on title with the assessor's office at San Bernardino, it shows up as a 2-bedroom, 1-bath condo, 800 square feet. When our real estate agent walked in there for the first time, she discovered it was a 2-bedroom, 2-bath condo with a loft of 1,200 square feet. So it was worth actually a lot more than the $130,000 that we originally thought. So we ended up rehabbing it and selling it to a retail buyer. And this is how it finally ended up. Our final numbers. Purchase price, $60,090. Total cost basis was $98,000. So we put in a total of $38,000. So that in that number is attorney's fees, servicing fees, forced place insurance, all that we did for due diligence. And then it went to cash for keys and also the rehab that we did. So that's everything. And when I calculate all my returns, I base it off, I use the total cost basis because I want to include all the extra money that we put into it. I know IRR is a better way of doing it, but this gets me close enough to gauge how that investment performed. Our net sales price, $164,000. Net profit, almost $67,000. Days held, less than a year, 269 days. ROI, 68% based on total cost basis. Annualized ROI, 92.3. So not all of our deals turn out this great, but you know, when you buy a portfolio of notes, you're going to have a gamut. You're going to have some that, you know, perform okay. You're going to have some that perform really well, some outstanding, and you know, some that you might lose. And it's unfortunate when that happens. A good thing to do is have a portfolio of notes just in case, so you get to spread that out. All right, Omar, do you have any questions about that specific deal? I know I kind of went into detail on that. I hope it was useful for people.
No questions on that specific deal, but just wanted to comment. I didn't imagine that when I was over there trying to knock on that door and find out who it was that was living in that place, that it would turn out as it did there. And
yeah,
and had so many things going on that one. That's fascinating.
Yeah, there was so much that went into that, and I don't know if you knew the actual details of the loan, because I think maybe you knew up to the point where, okay, we just foreclosed on this guy, and you know, we didn't know what to expect. But yeah, it's kind of interesting how the whole thing played out.
And just for some of you folks out there that aren't aware of, you know, what the wraparound mortgage is, it's basically just, you know, you said there was the original loan was in 1983.
Yes.
So I guess just to simplify it, say you got a loan for $1,000, the original loan was $1,000, and somebody put the second loan for $1,200. You know, when Andy says the delta, it's that difference. So that $200 is what the second mortgager guy would be putting in his pocket, right? And he pays the first loan.
Yep. Yep.
It's actually the difference in the payment amount, because it's annualized over the course of the life of the loan.
Right.
So, you know, the whatever the payment is on that original loan versus the payment on the new loan. And
well, and then the delta can be different from the actual like payment amount, because if they're amortized, you're going to have different amortization schedules. So you might be paying the underlying loan faster. Well, and you should always be in that situation. You don't want to wrap a loan that's bigger than the one that you're making. So,
Yep.
But I don't want to complicate that too much. I got a few more slides, Omar. Now I do want to hit the information for people who don't want to do what I talked about earlier. And then let's dig into the Q&A, and I'd be happy to answer those at the end.
Sounds good.
So where can you buy institutional loans? So the note brokers and sellers that you develop relationships with, I gave you kind of like the big concepts to think about. So you can do those things that I talked about earlier. I know a lot of people that come to real estate clubs, and I used to be one of them, where we tend to be very hands-on people, where we want to do the deals ourselves. And I get that. So I want to address that for the people out there who want to do this for themselves. So they have online note marketplaces, PaperStack, paperstack.com. That's a place I would recommend that you can go to. I've tried using them once, listed a couple notes to sell. I didn't have any luck with it, but I liked their platform. I liked how it was set up. And for people that I know through Bigger Pockets, I've heard nothing but good things about PaperStack. So I would suggest that you try that if you want to look for some notes that you can buy. Note MLS, DebtX, and Watermark Exchange. I haven't used these, but I've been to them before, and there are also places that you can try. And Google is a friend. So if you do some more Google searching, maybe you'll find some different ones. Okay, here are some other recommendations for those that want to do it themselves. What I do is not for all investors. It takes a lot of desire and motivation to get to that level. That story with Sean epitomizes that. if you are motivated and you really want to do it, you can do it. Just be prepared to do everything you have to, and spend time to do it. And then you'll have to catch up to those of us that are already doing it. I'm not the only one. There are a lot of other people out there that are well established that, have been doing this since, maybe 2008, 2009, that have a huge head start. So just keep that in mind. I recommend, though, maybe you should look at focusing on private notes, like seller finance notes, instead of institutional ones. I've heard of people that will also have relationships with small banks and small regional banks. I haven't done it myself, but I'm sure you can do it. So I would recommend kind of, fish where no one else is fishing. Start in your own backyard. Search county records, network with attorneys, accountants, chamber of commerce. Look for private notes. Find your niche and focus all your efforts on that. That's what I'm doing. It took me a while, and this is kind of real estate in general, because I've been involved in multifamily, condos, fix and flips, mobile homes, a lot of different things. But I finally found what I really like to do, and that's these non-performing notes. So all my efforts are right on that. So what I would do if I had to do it differently. So if God forbid, Sean got run over by a train or something like that, and he was out, I mean, I might be able to pick up with some of the relationships. I've been doing it long enough where I think the same guys would be doing business with me. But if I had to start all over again, maybe I had a bad breakup with Sean, and that's not possible. This is what I would do, and I would focus on. I would find seller finance notes that were originated 18 to 36 months ago. I would find the motivated sellers that are willing to sell for 60 to 65% of value. Keep in mind, a lot of people that do seller financing are doing it because they're having problems finding somebody to buy it at that price, because for whatever reason, and they offer seller financing as a way to make it easier to sell the property. But maybe 1.5 to 3 years after, they're like, well, I just wanted to get out of the property anyhow. Let me just sell my note for what it is. Those are the kind of people I would be trying to find. Once I found those people and I could buy it for that, I would work with the borrower and try and get to refinance them to get a full payoff. So I would be trying to find that $100,000 loan and buy it for $60,000, get them to refinance it and pay me out at $100,000. And then I would just do that over and over and over again. Okay, to learn more, I highly suggest, if you want to learn a lot about notes on an ongoing basis, go to biggerpockets.com. I frequent the discussion forum that talks about notes. I'm always on there. And I suggest to people, if you want to learn about notes and get a lot of current information, just go through the last year or so posts and just click on every single post that interests you. And that's actually how I got a lot of my knowledge. When I started out with Sean, I wanted to learn a lot more. He could show me a lot of stuff, but I wanted to learn more. So that's where I went. You can also check out my website, coastlinecapitalfm.com. I've got resources there. I've got a blog. I go into detail on a lot of different stories and share information about that. If you're also interested in investing in one of our funds, you can go there as well and learn about it there. And that's my phone number. And then we're coming up to my last slide, Omar. So that's me again, my website, email to contact me, and phone number. And so this concludes my presentation. I hope it was useful for you guys. And Omar, at this point, I know we're at 9, but I'm okay to answer some questions if you guys are.
Okay, certainly, yeah, and great job, Andy. That was some awesome information there.
Yeah, thank you very much for the info, Andy. That's a great presentation.
You're welcome.
So let me see here. We do get a few questions here. So here we have a Chin Wen here. And he says here, your partner Sean started with JP Morgan Chase buying just one note. How easy do you think it is to reach large banks these days buying just a handful of notes? Or do you think they require you to buy a large pool of notes to get a buyer/seller relationship started with them these days? So he's kind of comparing it from then till now.
Right. And that's a great question. And actually, Sean, this morning when I was telling him about the presentation, he said, yeah, just, that's the way it happened for him. And he's not sure exactly how it happens now. And I think that's true because back then there were so many notes for sale. It was such a huge problem, but Sean got his foot in the door with just that one note. I think the concept is still valid for right now. And maybe, I don't know if I would recommend doing the same thing that he did and going straight to those guys, because they're always shifting their focus to the next big thing or the next big projects. And I really don't think that notes are as big a thing as they were back in 2008, 2009. I think there's still a lot left over that's being worked out, but the crisis is kind of gone. And even with this COVID stuff, I personally don't think it's going to be anywhere close to what we had before. So for your questioner, I would say nowadays, I can't be 100% accurate, but I would say I got involved with Sean by bringing capital to the table. So I brought capital to the table. He brought access and management expertise, and that's how our partnership formed. So for your questioner, there could be a couple of different ways of doing it. I didn't talk about joint venturing, but there are a lot of experienced known investors out there that do joint ventures in just that kind of way. If you have some capital, you can go to some of these guys with experience and joint venture with them and leverage their contacts and expertise and get in that way. If you don't want to do it that way and you want to do it yourself, you got to have something. You can't go with nothing and just, well, I mean, Sean did back in the day, right? He was able to broker that deal. That's kind of a unique thing. For your questioner, if you have capital or access to capital, it'll be easier. But you do need to get that foot in the door with the first guy, whether it's a big fund or a smaller fund. Me personally, I'd probably try a smaller fund. And by small, I mean like $5 to $50 million fund size. Omar, before I forget, I want to see if I can give the host ability back to you.
Sure.
Do you know how I can do that?
Yeah, Omar, you should be able to do it on your end.
Yeah, I'd rather give you back control.
Well, last time when we were testing it out, you...
Well, I ended the meeting for me.
Okay.
So, okay, why don't we let Rashi work on that to get control back over to you, or you can let me know later or better. But why don't we go ahead and answer some more questions then?
Okay, this one's kind of like, this was actually more about the recording. I think sorry if I said it incorrectly, Vidnayan, it came in late, and will we have access to a recording? We are recording this, and there will be recording video snippets of it on our Facebook and YouTube. So So yeah, we won't make recordings of this available and, you know, notify folks there about that. Anthony here asks, you may have answered this already. What exit strategies are there during the due diligence period?
What exit strategies? Meaning,
During,
is he asking, like, once you get into due diligence, how can you exit from the transaction and do it in the right way?
I believe so. Anthony, if you can clarify your question. Oh, yes. Okay, he says yes.
Okay, yeah. So that's a good question, because just because you got the bid, it does kind of obligate you to complete the transaction, assuming that due diligence comes out right. So, like I said before, so when there's a problem with like a valuation or a title issue, you bring that to the attention of the seller, and you say, hey, seller, there's a problem with the value, or there's a problem with the assignments, or we're missing this, we're missing that. So you're giving the seller an opportunity to fix the problem. Once he has the opportunity to fix the problem, if he fixes it, then you're back on track, right? If he provides the assignment, or if he says, oh yeah, okay, the property is worth less, I agree with your BPO, so we can reprice it, then you continue going. But if you get into a disagreement, like the guy says, oh, well, I believe our BPO over your BPO, then it's kind of like, well, all right, if you're like that and we can't reprice this thing, let's kick it from the trade. That just means you're pulling it out. And then there's no harm, no foul on that. If it's a title issue and they can't fix it, then you have that discussion of whether it's a curable title issue or incurable. Curable means that all you need is the correct documents or the correct actions to clear up that problem. An incurable title issue means that there's nothing that you can do to fix the problem. It's there, and you got to take it as is. At that point, you have a discussion on the reprice. If it's a curable thing, or even if it's an incurable thing, but you're willing to take it as a buyer, then you say, okay, this is the price, and you go back and forth till you agree. If you agree on price, then you continue forward with the transaction. If you cannot agree on the reprice, then you kick the loan out. And that, again, that's a no harm, no foul. You found a legitimate reason, a legitimate problem with the loan. You addressed it with the seller, gave him the chance to fix it. If he couldn't fix it, then you tried to do the reprice. And if you can't agree on the reprice, then you just kick the loan out, and then you're out of it. But all your loans that you can fix the problems, or you can agree on the reprice, or that never had a due diligence problem in the first place, you're committed to buying those, and you need to do it. Otherwise, like I said before, you're probably not going to get much business in the future from that.
Okay, very good. Okay, and Anthony just responded, very helpful. Thank you, Andy. John asks, I think non-performing notes is for the non-faint at heart, very experienced ones. What do you think we can realistically start either investing money or working with you? Is that possible?
Okay, so I'll answer the question as it relates to me first. A few years ago, there was a point where Sean and I would do joint ventures with certain partners, and we found that that's not really something that we can scale, because you have to develop a relationship with someone else and you have to involve them in the process. A lot of people would say that they want to learn about the business, and then they end up being more passive investors, and that's perfectly fine. So we stopped doing joint ventures. We took more of an approach of we want to be more like the big guys who raise their capital first, and then they go out and buy their notes. So that gave us the idea of starting up the funds. So that's how our funds operate. We have a capital raise, we raise a certain amount of funds, and then we close it off, and then we go and buy notes, and then we liquidate those notes and make distributions back, and we don't buy more notes in that fund. It's kind of a one-shot deal. So that's how a person could do business with us. Like I said before, if you go on Bigger Pockets or you find somebody on LinkedIn who's involved in notes, you can develop a relationship with that person, maybe get involved in the joint venture kind of plan yourself. I do know of some other programs out there that provide education, and they provide access to certain notes. One of them I'll mention, it's the Note Assistance Program run by, I think her name is Jasmine Willow, Willois. I've never done a deal with her before. I've just met her a couple times at networking events. But one of the things that she does is she provides education for people, and then she has access to certain notes, and then she offers to sell them to her students. And the price point on those notes is a lot lower than what I typically buy. Those kind of notes are a different animal. There are different considerations when you're buying lower balance stuff. But I've seen a lot of kind of people who want to get involved in notes and do it themselves, get involved in a program like hers. Again, like I said, I can't recommend her. I've heard about her, and from what I've seen, I think she runs a good operation. There's some operations out there that you should stay away from, but I think that's a good answer to the question.
Okay, and Derek asks, are there any companies or individuals that you recommend for the purchase of contracts for deeds? In parentheses, CFD.
So my answer to that is no. I stay away from contract for deeds. Our sellers have some of those, and those deals come across our desk from time to time, but we don't have an expertise in them. We think that it's a different niche to be involved in, and we choose not to be part of it. So I don't know. Sorry.
Okay. Okay, and Mike asks, earlier you mentioned it depends if they are almost done with the foreclosure. What do you mean by almost done?
Okay, so I gave an example earlier. We were buying a few notes from one of our sellers, and that was a defaulted mortgage in Illinois. Borrower was in default in it for about 3 years. So our seller and the note holders prior to our seller had initiated foreclosure. In a judicial foreclosure state, you have to go through the court system to foreclose, and that means filing a lawsuit against somebody, against your borrower, for breach of contract, basically. So the previous owner of the note had filed the paperwork, filed the complaint. The midway point is kind of getting a summary judgment for foreclosure. And then the last step, well, not the last step, but almost the last step, is actually going to the judicial sale or the sheriff's sale, which is the foreclosure sale. So that note, we actually were closing on that pool of notes on the day of the foreclosure sale for that note. So that's what I mean by being almost at the end of the process. So you kind of think that if a note is almost all the way through its foreclosure process, and it's a lengthy one because judicial foreclosures take minimum 8 months, but it's more like a year. A note at the where you haven't started foreclosure is worth less than one where you have a sale date in, happening that day. So if you think about it, you're adding value to that note, the more stuff you do to get it to foreclosure. And so that's what I meant by being almost done with foreclosure.
Okay, very good, Andy. And last guy here, not really a question, just a comment here. Anthony typed in a real estate note investing by Dave Van Horn. I don't know if you've heard of that guy. He recommends that as an excellent book for those interested in learning more about note investing. So
yeah, Dave Van Horn is a well-known guy. He runs a fund called PPR. They've been around for a long time, like 10 or 12 years, and they have a good reputation. I don't know anything bad about them.
All right. Well, very good. Well, Andy, thank you so much for all this fantastic information that you've shared with us. And once again, folks, if you want to reach out to Andy, call him up at area code 949-371-6749. Email him, Andy at coastlinecapgrp.com.
Yep.
His website is Coastline Capital, F like Frank, M like Mary.com. And excellent. And a few more comments, people coming in. Wendy says, super helpful. Thank you, Andy. Mike, really thank you. Derek, thank you for your time and sharing some insight.
Sure.
Anthony came back, great presentation. Thank you, Andy. And yeah, wonderful, Andy. That was really cool, bringing back that Highland deal back to our memory.
Yeah. Yeah. Well, thanks so much, Omar, for having me. I really appreciate having me on here, and I'm glad to contribute. I will stop sharing my screen, and I'm going to say goodbye.
Well, okay. Okay. Looks
well, I don't know how else to give it over to you.
Let me see.
Unless you know.
I'm not too sure, but you know what? We're just about to wrap it up. So before you go, let me just quickly say our next meeting next month is going to be on August the 4th. Leo Clark will be there. He's going to be talking about infill development. So check us out there. Check us out at ocinvestmentclub.com. And everybody have a good night. Thank you for coming on out, and we'll see you next month. Take care, everybody.